Telix Pharmaceuticals, ticker TLX. Well, they slightly missed first half 2026 revenue consensus by about 0.5%. They reported nearly 477 million US dollars in revenue, which, I mean, it is still up 22% year over year. And that is alongside a net profit of $38 million, or 11.3 cents per share. Management actually reaffirmed their full-year revenue guidance of 950 to 970 million, and they noted they're tracking to the upper end of that.
Yeah, and the stock initially popped to $12.12 right after that, but it immediately faced some heavy volatility because of these underlying pipeline concerns we are seeing, which, makes perfect sense once you really start digging into the numbers.
Exactly, because reading this report for a deep dive today, it feels a bit like looking at a construction facade. You've got the shiny, beautiful $38 million headline profit painted on the outside, but behind the scaffolding, they are doing some incredibly expensive foundational work that is just burning through cash.
Right. Totally burning cash. And to see where that money is going, you really have to look at the massive divide between their two main segments. So the engine carrying the load here is precision medicine. I mean, that segment generated nearly $389 million, which is up 27%.
With a stellar 65% gross margin, right?
Yeah, exactly. And that is almost entirely driven by the demand for their prostate cancer imaging agents like Illuccix and Telix. But then on the flip side, you have the manufacturing segment.
TMS.
Right, TMS, which posted a $33 million operating loss. And you have to understand, this isn't just standard corporate overhead. In radiopharmaceuticals, you are dealing with radioactive isotopes that have incredibly short half-lives. I mean, they literally decay by the minute.
Right, so you can't just manufacture these drugs in bulk and let them sit in a warehouse somewhere for 6 months.
No, not at all. The production and the actual delivery, they have to be perfectly timed to the hour. So Telix is bleeding capital right now because they're building out the physical supply chain logistics to actually own that just-in-time manufacturing process.
Okay, but wait, hold on. If that infrastructure is so incredibly expensive, we really need to talk about the $40 million elephant in the room here.
Oh, the Regeneron payment.
Yeah, exactly. That shiny $38 million net profit we mentioned earlier, it only exists because of a $40 million one-time upfront payment from a collaboration with Regeneron. If you strip out that non-recurring check, their core operations actually lost about $11 million. So as an investor, shouldn't you be terrified that the core business is in the red just to fund this manufacturing pipe dream?
Well, management is firmly defending that operational loss. They are actively choosing long-term expansion over immediate profitability. They emphasize on the call that as a pure-play radiopharmaceutical firm, owning the supply chain is really the only way to support their massive upcoming pipeline.
So they aren't trying to squeeze out pennies today, they are trying to scale for tomorrow.
Precisely. And tomorrow relies heavily on studies like BYPASS. This is a huge one for them. It is looking at moving PSMA imaging, which actively hunts for prostate cancer cells, right to the pre-biopsy stage.
So instead of using it only after cancer is confirmed, they would use the imaging to guide the actual biopsy itself.
Right. And if they pull that off, they potentially double their total addressable market. That potential market expansion is exactly why they are guiding for such heavy R&D expenditure. We are talking between $230 and $270 million just this year.
But to justify that spend, I mean, they have to execute perfectly. And there are some serious regulatory snags in the way right now, like the delayed FDA resubmission for Zircaix, which is their kidney cancer imaging agent.
Yeah, that is a big hurdle. And there is also the looming September 11th PDUFA date for Pixclara. That is the FDA's strict deadline to decide whether to approve that brain cancer imaging drug. A rejection there would be a massive hit to the momentum they're trying so hard to build.
Plus, they aren't operating in a vacuum here. Analysts are warning about Lantheus's Truvu, which is a competing imaging agent. That one is expected to start eating into Telix's revenues by the fourth quarter.
Which is a very real threat, yeah.
It makes you wonder, though, is this aggressive $250 million R&D spend actually an offensive growth strategy, or is it just a desperate defensive necessity to keep rivals like Lantheus at bay?
Honestly, it is almost certainly both. I mean, you don't spend that kind of money purely to play defense, but they absolutely know they can't cede an inch of ground. They are racing to control the entire vertical.
From the raw manufacturing of the isotopes to the diagnostics, right?
Exactly. And eventually the therapeutics, too.
Which leaves you with a really fascinating question to ponder as you track this space. If Telix is willing to sacrifice today's underlying profitability to build a fully vertically integrated radiopharma pipeline, Will future biotech valuations rely more on sheer physical infrastructure and logistics control rather than just the clinical efficacy of a drug?
It is a huge paradigm shift. I mean, owning the delivery truck might soon be just as valuable as owning the molecule itself.
Definitely something to keep an eye on. Make sure you follow the show for your daily earnings coverage.